So you've got some money saved up, maybe from your first job, and everyone keeps telling you to invest it. But here's the problem. When you start looking into investing, you're hit with a wall of confusing terms. Stocks, bonds, ETFs, mutual funds, index funds, hedge funds. It's like a different language. Don't worry. By the end of this video, you'll understand exactly what each of those are, how they're different, and which ones you should actually care about when you're just starting out. What is a stock? This is the foundation around investing. When you buy a stock, you're buying a tiny piece of ownership in a company. That's it. For example, if you buy one share of Apple stock, you own a microscopic piece of Apple. That stock, or what they might call a share of the company, entitles you to own a portion of the value of that company and the rights to money if that company chooses to pass it on to the company owners or shareholders. And that's what you be, is a shareholder. Here's how you make money. If Apple does well and the company becomes more valuable, your little piece becomes more valuable too. You might be able to sell that stock to someone for more than you paid for it. That's called capital gain. Some companies also share their profits with stockholders, like I said earlier, through what's called dividends. Think of it like getting a small paycheck just for owning the stock. Now, the catch with stocks can go up and down a lot, and sometimes dramatically. The fancy word for this is called volatility. If you buy Netflix stock and they lose a bunch of subscribers, your stock value can drop as much as 30% in a day. At the same time, that stock can also go up a lot. When you have just one stock, you're taking chances on just one company. So if you want to reduce volatility or risk, you can do what's called diversification. Buying different stocks in different industries or areas. So if one stock isn't doing well, another stock might and can balance things out. Key takeaways. Stocks equal owning pieces of companies. Stocks can often offer high potential returns, but also higher risk if you're not diversified. Bonds, the safe option. Now let's talk about bonds. These are completely different. When you buy a bond, you're not buying ownership in a company like a stock. Instead, you're actually making a loan. In this case, you're not lending to your friend. Instead, you're lending money to a company or government. And in giving them that loan, they promise to pay you back with interest. Here's an example. When you buy a $1,000 government bond, often called a treasury bond, that pays 4% interest per year for 10 years, that means every year you get $40. And after 10 years, you get your $1,000 back. Simple. Now, that's not a lot of money. So why would anyone choose a bond over stocks? Because bonds are generally way less risky. The government, who owes you money, isn't going to disappear overnight. A solid company isn't also likely to just vanish. You know what you're getting. What you're doing is you're trading the volatility you might get from stocks for the promise of consistent payments. But that less risk also means less reward. People who choose bonds are often people looking to protect their money more than grow it, like people who are close to or in retirement. At that point in life, a big swing in their stocks could hurt their retirement nest egg. And because they are older, don't have a lot of time to wait for a stock to recover. Key takeaway: bonds equal lending money for steady, predictable returns. Lower risk, but also lower reward. Think of them as your boring but reliable part of your investment mix. So now you know what stocks and bonds are. But here's the issue. Remember how I said putting all your money in one or two stocks is risky? That's because if those companies tank, you could be hurt. The solution is diversification. A fancy way of saying that you need to plan to spread your money across dozens, if not hundreds of different investments. But here's the problem. If you have only, say, $1,000 to invest, you can't buy meaningful amounts of different stocks. That's because stocks like Apple are currently valued over $250 a share. With stock prices like that, there's not much room to buy diversification. Or is there? This is where what's called a fund comes in. A fund is a type of investment product that pools money from thousands or even millions of people and uses all that money to buy a big basket of different stocks and bonds. When you invest in a fund, you own a tiny piece of that whole basket. So you get diversification with the money you have. Let's talk about the main types of funds. Index funds, a smart choice for beginners. Index funds are probably the most important thing in this entire video for you right now. An index fund is a type of fund that copies a market index. Now, what do I mean by market index? It's basically a list of companies that represents a chunk of the market. The most famous index is the S&P 500. That's the 500 biggest companies in America. Companies like Apple, Microsoft, Amazon, Tesla, Coca-Cola, you name it. Now, when you buy an S&P 500 index fund, you're automatically investing in all 500 of those companies at once. Your money is spread across the entire US economy. Why this is genius? From an index fund, you get instant diversification. You own 500 companies with one purchase. You also get super low fees. Because the fund just copies the index automatically, there's no expensive fund manager to pay. Fees might be as low as 0.03% per year. We won't talk about it right now, but high fees from other funds can actually cost you hundreds of thousands of dollars over the long term. And with index funds, you get a strong track record. Funds like the S&P 500 have averaged about 10% returns per year over the long term. Fun fact, Warren Buffett, one of the greatest investors ever, recommends that regular people just invest in low-cost index funds. He literally bet $1 million that index funds would beat fancy, professionally managed hedge funds over 10 years. A bet that he won. Key takeaway: index funds are the simplest, cheapest way to invest in the entire market. And this is where most young investors should start. Mutual funds, the index fund's expensive cousin. Mutual funds are similar to index funds, but with one key difference. They're actively managed. With an index fund, a computer just copies an index like the S&P 500 that we mentioned before. With a mutual fund, there's an actual fund manager or a team that's actively choosing which stocks and bonds to buy, trying to beat the market. Sounds good, right? Someone picking the best investments. Here's the problem. They charge way higher fees for this service, often 1% or more per year instead of something like the 0.3% we talked about earlier. And here's the kicker. Most mutual fund managers don't actually beat the market. After you account for their fees, most perform worse than a simple index fund. Now, there are some good mutual funds out there, but as a beginner, you're probably better off with index funds. After all, why pay more for worse results? Key takeaway. Mutual funds equal actively managed funds with higher fees. Most don't justify the extra cost compared to index funds. ETFs, index funds' more flexible sibling. ETFs, or exchange-traded funds, are very similar to index funds, but they trade on the stock market like individual stocks. Here's what that means. With a regular index fund, you can only buy or sell once per day after the market closes. With an ETF, you can buy and sell anytime during market hours, just like you would buying a share of Apple. Most ETFs are just index funds in ETF form. For example, SPY and VOO are both S&P 500 ETFs. They do the same thing as the S&P 500 index fund, just with more flexibility. Now, should you care about this difference? Honestly, not really when you're starting out. If you're investing for the long term, which you should be, it doesn't matter whether you can trade during the day or not. The main thing to know is that ETFs and index funds are basically the same thing for your purposes. So both are great options. Key takeaway. ETFs are index funds that trade like stocks. Same benefit, slightly different structure. There's no need to overthink it here. Finally, hedge funds. If you watch the show Billions, you've probably heard this term and thought it sounds fancy and exclusive. And that's because it is. Hedge funds are private investment funds for wealthy people and institutions. And they have a high cost of entry. We're talking minimum investments of $1 million or more. Now, hedge funds use complex strategies, things like short selling, derivatives, leverage, all in an attempt to make money in any market condition. And to do that, they charge massive fees, usually 2% per year, plus 20% of any profits. Here's the truth. You can invest in hedge funds right now, and that is completely fine because you don't need them. Remember Warren Buffett's bet? Index funds beat hedge funds. Hedge funds are for the ultra-wealthy people who need specialized strategies. You, on the other hand, need to master the basics first. Key takeaway. Hedge funds aren't accessible to beginners and aren't necessary for building wealth. Don't worry about them. So let's recap. Stocks are about owning companies. Bonds are about lending money. Index funds allow you to own the entire market automatically. Mutual funds are actively managed and usually too expensive. ETFs are index funds that trade like stocks. Hedge funds are exclusive, complex, and probably not for you right now. You've got this. Now go build that wealth. And if this content was helpful for you and you want to learn even more, hit that like button and subscribe and share it with others. Thanks for watching.